It is 4 p.m. in Singapore and 9 a.m. in London. Welcome everyone to the Asian Banker Live, our online broadcast platform that aims to enhance the understanding in the industry by bringing together senior opinion leaders and practitioners to examine current critical issues. This platform comprises an incisive 30 minutes panel discussion with a short Q&A segment in which our audience who've called in can participate in. I am Fu Boon Ping, the Managing Editor of the Asian Banker. Today, we'll be looking into the key trends in technology that will shape the priorities of banks and financial institutions in the year ahead. Regulation and technology have arguably been the two hot issues that have dominated the agenda of the industry for much of the last half decade. Much efforts have been put into financial and prudential regulation, even regulations to enhance the IT security and protection of financial institutions in this age of, quite frankly, rampant cybersecurity threats and attacks. In comparison, regulators have been relatively slow to recognize and leverage on the new emerging technology that can help enhance efficiency in the industry and to bring it into the modern, connected, or shared economy, in line with what the fintechs, telco, e-commerce, and social network companies seems to be doing so well in. The early responses from regulators have been quite conservative or restrictive, to say the least. Basically, if it's not explicitly stated in the regulation, you are not allowed to do it. This happens in many jurisdictions. However, on the other extreme, we have countries where the industry have been allowed to move ahead of the regulator. One good example would be in China, which explains why internet finance is flourishing there. But now that there have been some lapses, the regulators are starting to rein in the industry. However, this may not be the ideal approach. There have been some exception and example of leading practices. We particularly like the approach of the FSA in the UK that have allowed challenger banks to operate, and also in the Nordic countries, in Sweden, for example, where regulators are pushing the industry to collaborate. And that is why this is perhaps the most digital or cashless economy in the world today. There is increasing recognition that as much as digitization is left to individual institutions in the private sector to develop, there are matters of national infrastructure and framework, and even at a regional level, that regulators would need to lead and point the industry in the right direction. For example, the adoption of open APIs and finance or banking as a service platform, and the use of cloud computing and for creating common payment infrastructure. Thankfully, an increasing number of regulators are moving in the right directions. In Asia, in India, for example, Australia, Singapore, Hong Kong, Taiwan, and Korea, regulators are pushing for more open API adoption, making clearer rules for cloud computing, and even regulation to allow fintechs and digital-only banks to operate and to reach scale. And as a side note, some detractors in the fintech industry believe that regulatory sandboxes and creating fintech hubs and ecosystem are great for getting fintech startup to set up business, but are more likely to stunt their long-term development and ability to scale. So more can be done to get the industry to move in a more integrated and unified fashion. Today, in this Tab Live sessions, we'll be discussing the following in our agenda: the key trends in technology investment in 2016, key priorities of banks in the year ahead, recent developments and key current focus on digitization, as well as the future focus areas in technology. And to do this, we are very happy to have as part of our panel today, Chris Skinner, who perhaps is best known to the industry as an independent commentator on the industry and fintech through his blog, thefinancer.com, and also as the author of best-selling book Digital Bank and its new sequel, Value Web. And from the Asian Banker, we have Niti Agawan, our Head of Research. Now, before we get both Niti and Chris to share their thoughts, let me share some information on how you can participate in this live session. On the WebEx screen that you can see in front of you, to ask a question, you can write your question in the chat box at the bottom right corner of the screen, and we will be asking those questions during the Q&A session on your behalf. Right now, I'd like to ask Niti to start the session with a quick overview of the key developments in technology that shaped the industry in 2016, and followed very briefly by what she sees as the priorities in 2017 among the CIOs that she has spoken to. Niti?
Thank you, Boonping. Good afternoon, everyone. 2016 saw rapid progress in disruptive technology, bringing a paradigm shift in the thought process of institutions towards technology adoption and transformation. I'll share with you some of the key findings from our Technology Award submission and from our surveys and discussions with Head of Technology in Asia Pacific. Looking at the current slide, we're looking at the key challenges and key pain points that the CIOs discussed with us during our discussion. Now, these are some of the key challenges. One of the most common challenges pointed by bankers was the need to constantly evolve in order to keep pace with the technology and to bring this transformation with agility in their existing systems, which is actually, a lot of them are legacy systems. Besides this, bringing simplification in IT infrastructure, finding the right talent, managing cyber threats, and integrating silos were some of the other key challenges that they highlighted. Let us look at the slide number 9, which is the submission findings. Now, Asian Banker runs Technology Innovation Awards, for which we receive over 140 projects every year. These projects show that the core theme of digitization rules the technology investment in 2016. In fact, over the last 2 years, especially in 2016, the focus has significantly shifted towards mobile banking and payments. Banks seek to continue to improve customer engagement with innovative apps like lifestyle features, mobile wallets, P2P initiatives, among others. But we are also seeing an increasing focus towards channel innovation, improving customer experience through investments in data analytics, self-service channels, and channel integration initiatives. Core technology projects such as core banking that used to dominate the share of projects in previous years have actually moved down the ladder. Let's look at the next slide. Now, this slide shows, based on a survey of banks, on the key priorities in technology investment in 2017. Now, most bankers plan to continue to focus on improving mobile and digital channel experience, digital payments. This includes payment technologies such as near-field communication, contactless payment, and wearables. We also see convergence of messaging apps and integration of micropayments. Data analytics was the other big area that most of the CIOs highlighted as their priority. Universe of digital information is growing exponentially every year. Banks increasingly plan to strengthen data management and harness actionable insights based on big data. Along with digitization comes the issues of cybersecurity, and that will remain a key focus for most banks. Authentication features such as biometrics, fingerprints, or facial recognition, these are being increasingly explored by banks. Cloud computing, because of the immense efficiency benefits that it can offer, once the data security concerns have been managed, is the other focus area. We also saw some new, relatively new areas which were not highlighted in previous years during our discussion, and these were blockchain, API banking, and increasing fintech investment by banks. If you move on to the next slide, we see the average technology spending by banks across the Asia Pacific region. Now, challenging operating environment is forcing banks to trim their cost structures. However, investment in banking technology continues to remain significant. Based on a survey of leading banks in Asia Pacific, we estimate on an average about 3.7% of net operating income of banks is devoted towards technology. That said, however, there are significant variation in individual banks' technology investment based on their current IT needs and future strategy. Also, the competitive market and operational priorities play a significant role in this investment decision. So, for example, countries like Singapore, Taiwan, Australia, they lead in this field in terms of technology investment. Moving on to the next slide. Now, we believe that holistic digitization will be the key priority for banks as they look to compete with new entrants in the market. Best banks look at automation, connectivity, mobility, agility, and integration as key pillars in this transformation and enabling digitization. Effective use of machine learning, artificial intelligence, and robotics can enable better automation going forward. Towards connectivity, new models such as chatbots offer increasing personalized interaction, while location-based services can enable banks to offer real-time offers. Besides mobility, banks also see greater agility in customer engagement through faster product development, through real-time insights, risk management, and real-time decision-making. Most banks are still striving to achieve a multi-channel integration towards an omni-channel seamless experience, something that is definitely not easy to achieve. Now, new players lack the legacy baggage, and they can better harness the power of big data analytics. So the banks are rapidly building towards a data analytics capability. Many banks are looking at strengthening their data integration, which is actually residing in silos in many cases. So leading banks look to overcome this and create a customer-centric view across products, channels, and interactions. Now, this big data can provide valuable clues to predict and identify customer behavior and facilitate contextual marketing, better ability to target the right customer's right product at the right time. So that's one key area that we see the banks look to improve their capability on. Now, if you look at the current slide that talks about the 5 big areas that we see which will remain focused in terms of banking technology over the next few years. Now, current focus on mobile and digital payment capability will strengthen further, and new innovations are expected. Banks will move towards mobile-first strategy, providing to provide and build services using smartphone as the focal point. Artificial intelligence will probably evolve from a buzzword to a critical capability that will help banks to drive better outcome for customers, tailor advice, and also increase efficiency for banks. We'll see increased deployment of machine learning, artificial intelligence, and robotics. The cyber security, and especially security in the IoT environment on interconnected things, is going to be particularly challenging. We believe that multi-layered security enabled by analytics, insight, biometrics, and adaptive security will become a key requirement for every institution. Blockchain, although still at an early development phase, it's expected to possibly reach mainstream adoption in the next 5 to 10 years time frame. The investment is already growing. It's crossed $1 billion mark last year. So we expect to see increased focus there, more number of proof of concepts and use cases coming out from this area. Banks will continue to look to improve operational efficiency through automation of processes, cloud computing, and API banking. And finally, banks will have to cooperate, partner, and coexist with fintechs. They will need to learn to think and act like a fintech and develop a nimble and agile technology capability. Well, with that, I come to the end of my presentation. Thank you. Over to you, Boon Ping.
Thank you, Niti. Very interesting few charts that you showed there. Okay, as we set up the chart or the presentation for Chris, I have a question for you. You mentioned about the emergence of new challenger banks and fintechs. We know in Asia that there are a few markets that are, where the local regulators, such as the FSC in Korea, that has allowed the setting up of digital-only banks. In these scenarios, what do you see as the biggest challenge for incumbent banks, and how do you see them, taking up the digital challenge?
Well, definitely. I mean, see, the fact is, unlike new entrants, banks carry a legacy baggage, and they have a huge regulatory compliance requirement to meet as well. Unlike many fintech. So the biggest challenge for banks is right now to rapidly transform themselves in order to compete with these new entrants. Now, and also the fact is the customers today, especially millennials, they have different expectations. They're demanding a different level of banking service. The banks have to rapidly digitize to meet a competitive and disruptive technology of competitors, the new competitors, the new challenger banks that we are seeing coming into market. Now, so bringing this transformation with agility is a key requirement, also biggest challenge. But frankly, how they can do it, I would say that look at digitization more holistically from an organization-wide view, like integrating silos of data, integrating silos of system towards a customer-centric approach. Data analytics will definitely play a key role here. They can look at customers more holistically in parallel to being able to gear their channels, especially digital channels, and being able to tailor products to meet the unique requirements of customers. Towards a better and a seamless digital interaction. I think those would be the critical areas that the bank should focus.
Okay, great. Thanks, Nidhi. It will definitely be an interesting and challenging year ahead for the banks. And what will be the key developments and opportunities in 2017? Chris, I'd like you very briefly to give us an overview of where you see the banking industry heading, as much as looking at new technology and fintech in 2017. I think we have got your presentation set up, so you can walk us through that, please.
Thanks, Boon Ping, and good afternoon, everyone. It's early here in the UK, so I'm going to give you a quick overview of the 11 key trends that we found were being discussed in the January blogs around the world, and that most bloggers and analysts were forecasting the big trends of 2017 last month, and I actually went through 20 of the leading sites to see what the commonalities were in their thinking, and there were 11 major themes that were coming through all of the expert analysts' views. The first of those was that this year is going to specifically focus on, as the number one priority, taking away all of the issues related to the customer journey when they're using financial services, as in the friction that you find when you're paying for things, when you're checking your balances, when you're trying to contact the bank, when you're doing KYC, any process that involves paperwork, any process that involves customer pain is going to have a magnifying glass put on that area to remove that pain and make it as simple as possible to do your financial planning and financial services. We see that particularly with the fintech startups, and a good example is Stripe. If you're not familiar with Stripe, provides a very simple API for merchant checkout, which a small business can set up online within minutes and have people checking out on their website. If you try and do that with bank services, most banks will take days to set that up for a merchant. So minutes is a good resolution. The second big theme is insurance technologies, or InsurTech as it's known for short. There's been a wave of new fintech startups in insurance in the last year, including companies like Augury, Buzzmove, Cocoon, FitSense. Probably the leading ones are the US peer-to-peer insurance firm Lemonade, and the Australian insurance firm that provides insurance on a pay-as-you-need-it basis called Trov. That last one in particular is interesting because AXA has partnered with Trov to offer their services to the AXA global insurance user base. So that's a big move. And again, insurance technologies, using the Internet of Things, using capabilities to do technology analytics for insurance purposes is a big trend this year. Equally, RegTech has taken the headlines in a lot of spaces. As Boon Ping mentioned, the UK FCA has a regulatory sandbox that's encouraging startups to test what they're doing in a secure, confined environment. We've seen that copied by the Singapore Monetary Authority, Dubai, and various other countries now trying to innovate in the regulatory sense. And equally, it's not just the regulators supporting RegTech, but the regulators using technology. So regulatory technologies that provide analytics of bank trades and services in real time connectivity and context is a big area that's arising this year. In Europe, we've also seen a move towards opening the banks to open platforms, particularly under the Payment Services Directive 2, or PSD2 as it's called, which has an open API requirement for European banks. But equally, I think globally, we're seeing more and more partnerships between banks and fintech startups because going back to the regulatory technology piece, the fintech startups can take away a lot of friction within the bank, not just from the customer journey, but from the overhead that banks have in their services, such as KYC. So working with fintech startups to take away inefficiencies in bank processes is a big partnering move that we're seeing this year. But to make that happen, you need to see a change in the constitution of the bank's boardroom, which typically is full of elderly gentlemen. And equally, banks' biggest failing is that they're run by bankers. 97% of banks' CEOs are bankers. And I'm not saying that you have to get rid of them all, but you need to have a balance. 77% of banks' boardrooms have virtually nobody who has any technology experience as a professional career move in their career path towards the boardroom. And this year, we're going to see a big shake-up in banks' boardrooms to have more balance between bankers and technologists, or financiers and technologists. Because when we talk about fintech, banks are fintech companies too, but you can't be a fintech company if you only have bankers in the boardroom. So reform of the bank boardroom is seen as a big deal this year, and getting more balance between the technologists and the financiers in the decision-making and leadership is a big change. In terms of geographies, we're seeing the emerging markets growing as a major focal point, because if you look at sub-Saharan Africa, Indonesia, Philippines, and South America, a lot of markets where the mobile technologies for financial inclusion are changing the game. And in particular, when we see mobile technologies for financial inclusion being used, a lot of what's happening there are disruptive changes that can be taken into developed markets, such as using mobile wallets. More mobile wallets are used in the 19 countries of sub-Saharan Africa than bank accounts. And that's something we can see replicated into Europe and USA for not just the people who are not on the banking system, but potentially easing the path of using mobile wallets like Apple Pay. In the context of taking friction away and improving services, one big thing this year everybody's talking about is chatbots, in terms of having an engaged conversation with a machine when you're connected to the bank's apps or online services. That will develop not just from a chatbot, but into machine learning, artificial intelligence over the next few years, so that eventually you'll be engaged in conversations with the bank that appear to be with humans, but actually they're with machines. That's starting this year with the chatbot reformation, but it will get bigger. And as part of that, it's integrating the bank's services into the social media that's used so that it's seamless. It's interesting that if you look at Alipay in China, Venmo in the USA, Paytm in India, or any of the big mobile wallet services, they are seamlessly working alongside the social media services that customers use in those countries. Alipay, for example, is a complete environment for not just buying and paying, but socializing and talking. And that seamless integration between buying and talking is going to become a big theme over the next few years, as is this seamless integration of your things with your bank services. One of the big themes I've talked about for some time, and it's a big theme in the book Value Web, is the building of an Internet of Value to support the Internet of Things. And that when you have billions of devices making trillions of transactions of very small value, what's the network that supports a real-time, very cheap transactional system that's underlying those things? That's not yet been determined, but in my view, it's partly to do with mobile wallets, fintech startups, blockchain, shared ledgers, digital identity, and a lot of underlying pillars that have to be there before the Internet of Things can truly rock and roll. And so this year, a big theme is around how fintech companies are integrating their capabilities with the concepts of the Internet of Things, and also with some of the Internet of Things that are around today, like the Nest and Hive home management systems. I already mentioned open banking under the regulatory reforms, forcing banks and fintech companies to partner with each other, but equally marketplaces, platforms, application program interfaces, open banking systems are a big ticket development that's being discussed actively around the world right now, as in making banking and financial services plug and play. So it's not proprietary and internal, but it's open and external. Again, another big theme. And part of that is going to be creating shared ledger systems and blockchains that can work together in a true usable sense. Blockchain's been overhyped, it's not delivered, but this year I think we'll start to see the first delivery of real use cases of blockchains, where it moves out of the laboratories and into the real world. So there's 11 key themes. Just one last one that wasn't in the analysts' views, but it's in my view, is that cybersecurity is a big, big worry for all of us, and it will continue to be so. And I've recently interviewed quite a few hackers, and what's interesting is they say hacking is nothing to do with technology, but it's leveraging the trust that humans have in other humans through social engineering. So bear that in mind when you let your employees talk to external third parties. On that note, I'll hand back to Boon Ping and Nitty, and that concludes the 11 big trends that I have in technology and financial services this year.
Okay, thanks, Chris. Very interesting 11 trends there. I just want to touch on the very first one that you mentioned on the removing friction from the customer experience, a very core part of what banks are trying to do, and which seems a lot of the fintech and a lot of the more technology-oriented companies seems to have a better handle on. And I want to relate that to your point about partnership and last point about open APIs. What have you been observing in terms of banks' attitude towards a partnership and with fintech? By some statistics today, in terms of investing in fintechs, the bank's participation rate is still very low. 25% of all investments in fintechs are actually done by banks. Are they doing enough? How do you see banks actively opening up their infrastructure, opening up their system for open banking?
Well, you have some banks that want to see themselves as leaders in this space, like BBVA and DBS. So they're actively investing in hackathons and fintech partnering incubators. You've got Barclays with their RISE program that's actively supporting fintech companies working in their development laboratories. But then when you move below those, some would call marketing programs, I would say there's actually some real delivery in those programs, but it's a point of view. When you move beyond those few names, there's actually very little happening. So there's a lot of banks watching the fintech markets, but there's not a lot of banks actively doing much in those markets in the last few years. I think that is starting to change because of the regulatory sandbox approach of bringing in companies that can take away bank efficiencies. So, for example, in the FCA sandbox, you've got companies that are looking at the paperwork overhead, particularly know your client and customer onboarding, and seeing how they can automate those processes for the banks. And so maybe the bridge between banks partnering with fintech is the regulator.
Okay, but some detractors say a lot of these regulatory sandboxes are working in favor of the banks, forcing fintechs to actually work for the banks rather than encouraging real innovation.
Yeah, I mean, there is innovation in what's going on there, but it's directed towards improving the bank system rather than replacing banks or any of that sort of thing. In fact, it's quite funny in that so much discussion has taken place around fintech replacing banks, and yet I don't see a single fintech company that will ever replace a bank.
Right. Now, you also spoke about the need for bank board management, the composition to change. Tell us, are there examples right now where some of the banks are moving towards, at the boardroom level, having more technologists join the board? And particularly in Asia, how do you see this evolving?
I mean, most banks don't see technology as being as critical as I do, primarily because they're run by people who've come through risk management compliance and financial management structures. That means that they really understand leverage and exposures, but they don't understand blockchain and APIs. And that's, to me, a fault if you don't have that balance in the boardroom, considering how critical technology is today. It does vary, and one of the things that I've just been writing about, for example, is that when you look at the big internet giants of America, Google, Apple, Facebook, Amazon, not a single one of them has entered into financial services. When you look at the big internet giants of China and financial, Tencent, Baidu, they have all entered banking and financial services. Now, the difference is that the internet in China started when a lot of the business structures were quite archaic, and they've been completely overhauled in the last 20 years by the internet, by these new startups, and by government support and encouragement. In America, government discourages commerce sites entering into financial services because they see it as something that should be separated. That's why Walmart's never been able to get into banking in the USA. So it's quite intriguing looking at the different approaches between Asia, where there is actually quite a lot, in particular in China, but in other economies, South Korea, Taiwan, Singapore, Thailand, Malaysia. You know, there's a lot of economies that, in my view, are doing far more innovative banking services with technology than we're seeing in the USA.
Okay, and you spoke also of Internet of Things. How and by when do you see banks optimally unlocking business value from this?
Well, it's going to start in insurance.
You talk about insurance where they are leveraging of this technology in banks.
Yeah, the Internet of Things is going to start in insurance, and the reason why it starts in insurance is that you need to insure your things. And so I mentioned the example of Trov, which does pay-as-you-use insurance. And the idea of that is that rather than taking out an annual policy, each time you leave your home, you might say, I'm going out with my bicycle and my camera worth $2,000. I want to insure that for the next 8 hours, and it's going to cost me 10 cents. So that's one example. Again, both of those things, your bicycle and camera, could be internet enabled and therefore tracked and traced through the insurance structure. There's one insurance company talking about smart homes and using smart home security access to monitor when you're not in the house and whether you've left a door or window open, and alerting you to those exposures. Eventually, the financial system is going to catch up with the Internet of Things, because if you have a fridge ordering groceries, a car ordering fuel, television ordering entertainment, all through the internet, then you've got to have a transactional system that supports and enables them doing that. And right now, the exposure and concern, if I'm honest, is leaving that to the Alipays and Apple Pays to manage that whole structure of aggregating small payments between things, and banks not actually being involved in it as things, full stop. I think it's a bit of a blind side that banks haven't yet woken up to.
Okay. Now, as you mentioned, a lot of the fintech initiatives today that we see, you describe them as marketing, and in many senses that is true. What should be the strategy for banks then going forward in enabling technology to achieve what Niti mentioned earlier, a more holistic digitization, and to have fintech be part of that strategy?
I mean, if you look at where the theme of digital bank came from, the book that I wrote a couple of years ago. It's all about banks being built for physical distribution of paper in a proprietary structure focused on buildings and humans, and having to convert that structure to a digital distribution of data in an open marketplace focused on software and servers. And that is a big change, not just of the organizational structure and infrastructure of the bank, but of the culture of the bank. Now, I personally think there's 5 to 10 years time ticking right now, where if a bank doesn't convert to that digital structure, then they're going to start to fail. And they have to have the leadership to change that organization and that culture to move to that digital structure and platform, because traditionally banks have been proprietary and internal and controlled everything, and now they have to be open in a marketplace that's partnering with external players, and that's a very different level of thinking, which is why we need the balance of technologists and financiers in the boardroom. Now, 10 years from now, do we really believe that a bank that has lots of buildings and humans and bankers who manage risk and understand financial ledgers are going to be the ones that are surviving and thriving? I don't think so. It's going to be those that have converted that structure into a digital platform that's open and connected globally. So the time is ticking. You need to get a strategy in place to convert the culture and organization, not just a digital project. And any bank, and I meet so many of them, that ever mentions omnichannel to me, I kill them, because channel is a word like tape record. It's last century. There are no channels. There's just a digital structure that has access. Stop talking channels. If you talk channel, you're dead meat.
Yes. And a lot of the banks still see this, encourage this in what they are familiar with in banking terms, not really looking at it from the customer's perspective, but from internal perspective. So as you mentioned, looking at their own branch, digitalizing the branch, digitalizing products, and not really digitalizing the customer experience. And,
well, that's why I say there's a clock ticking, in that customers haven't caught up yet with the digital transformation, because you have a lot of legacy customers in a lot of economies. You don't have that in China. In China, $3.2 trillion worth of mobile payments will be made this year, which is more than is transacted in cash. And 60% of Chinese consumers are using mobile financial services frequently, which is more than any other country in the world. They've completely embraced the move to mobile, because what was there before was archaic and didn't work and didn't include many of them. So we're going to see that ripple effect over the next 5 to 10 years around the world, from emerging economies, from China and India, into the European and American markets and the other developed markets around Asia. And the consumer experience is one where, when the legacy consumer sees the mainstream consumer using digital transformation services from other players, do you really think they're going to stay with a legacy player that's offering a branch transactional structure that's not automated? I don't think so. Branches will still be required by a lot of consumers, because you have to bear in mind the trust in finance, and trust is created by face-to-face connectivity as well as digital connectivity. But if 90% of the connectivity is digital, then you really don't need nearly as many buildings and humans.
Okay, so the future will definitely look very different, where we have to separate and open up their system and look at how the other players from e-commerce, from the social media, from fintech, they're transforming this connected shared economy. And unfortunately, the banks, unlike the insurance companies, which are recognizing this early, kind of jumping on board and working with fintech. But it is still early. The banks in no way have missed the boat yet, but no, there's still a lot to be done to move them to embracing what we call holistic digitalization. On that note, I see that we have got no questions from the audience. We'd like to end the session here. I want to thank Chris and Niti for your insights and analysis, and to our audience for calling in. We hope that you have found today's session insightful and useful, as always. And if you have missed any part of the session, a recording of this will be available on the Asian Banker website. So do visit the website, and if you'd like to listen to a playback of the session. Until our next event, which will be in about 2 weeks' time, we wish you all a good day. Bye.